Good morning, everybody, and good afternoon to anyone who's in the UK at the moment. So the title of today's webinar is The Best Moving Average, and this is based on a presentation I did at the Orange County Trading Workshop in June. And I've updated these slides through to the end of the week, last week. So there's really current data here. It's an interesting sounding title, and we'll get right into it and explain what it's all about. I mean, as everyone knows, trading, when you start trading, you learn about technical analysis. The very first thing you hear about is moving averages. And I've drawn a few on the chart here. You can see that I'm looking at, this is actually Microsoft in January. And so I'm looking at three moving averages here, 200 period simple. They're all simple moving averages, the 50 period and the 20 period. And so one of the first things that you tend to hear is that you should not trade stocks that are below a certain moving average, whatever it is, the 200, the 50, the 20, whatever. People have, this is just something that's bandied about all the time. And so I wanted to come up with a way of testing if a moving average has any effect on price. And one of the things that we have, one of the templates that's available in EdgeRater really helps with this is the tagging template. So the idea is here that you break down this chart into a series of bars. This is 1 year period. So there's 252 bars here. And then the idea is you look at the price, the close price on any one of those bars, and then you look at the close price on the following bar, if there was a gain or a loss. And then you add all those together, you do some Monte Carlo analysis on those, and you figure out which bars performed better. Like, would you prefer to be in a certain set of bars or a different set of bars? If you were going to, say, buy that trade, so buy at the close of one day, sell at the close of the next day. And you can really think of this as breaking down the entire year then into just those 252 bars. The end result of trading, if you were to trade from day one and buy at the close of one bar, sell at the close of the next bar, and then buy at that same close and sell at the next close. If you did that all the way throughout the year, it would be the equivalent return as buying the close of the first bar and doing nothing until the end of the year and selling the close of the very last bar. But by breaking it down into individual bars, then that gives an opportunity to look at some technical indicators in conjunction with those bars to see if they have any bearing on the price movement. So that's the idea. So the very first thing I thought I would try is the 20 period moving average being above or below the 50 period moving average. So this is something that I've heard before. If the 20 period is above the 50 period, then that could be it. That's, I'm not saying this is true. I'm saying this is what you tend to hear. Then that's clear sailing. You can enter into alongside trades and everything is good. So we'll take a look closely at this chart. And I've broken this down into the times when price is above the 20 period moving average. And then when price is below, sorry, not price, when the 20 period moving average is above the 50, and then when the 20 period moving average is below the 50. Those times when the 20 is below the 50 are in these boxes here. So there aren't that many in 2021 for Microsoft because 2021 was pretty much an up year in the market. And there were 3 occasions when the 20 was below the 50, just 3 occasions. So then the question that you can ask yourself is, would you prefer to trade from these bars that are outside of these boxes, okay? Or choose your trades. If you had to sort of put your hand into a black bag and pull out a bar to go long on, would you prefer to put your hand into the bag that's full of bars where the 20 is below the 50, or where the bag where the candles in there are candles where the 20 is above the 50. If you take a look at this and just analyze these bars, I think it's maybe not 100% obvious, but you can see that, for instance, in this first box, the bars here seem pretty good. Okay, there's lots of good gains in these bars. In this second box here, you've got some bars that were negative, some, but you've got quite a few sort of positive bars with good percentage gains. And this box up here, you've got some really good bars, especially this second from last bar. If you were in that trade on the close and then exited on the following close, that's a great trade. So if you select from the bag that contains those bars versus the bag that contains all of the other bars, that's the question: what would be best? So that's basically the idea of this analysis. So here is the answer to that question. So this is by running a Monte Carlo analysis on those bars. The way that the Monte Carlo summary is broken down is you have a final equity. If you were to put your hand into that bag and pull out those bars or those candles 1,000 times, and you strung all those trades together randomly, what would your final equity at the 50th percentile be? It can vary, of course, every time you run that 1,000 simulations or pull out 1,000 bars and replace them, pull out another, so you basically put your hand into a black bag, you pull out a trade, you log that trade, you put that trade back in, or that bar back into the bag, and then you pull out another bar and you string those together. Every time you do that, you've created a sequence of 1,000 trades. And so you're going to end up with, depending on the way the sequence works out, you're going to end up with different final equities. So the FE50 is the final equity you end up at the 50th percentile. So FE5 is your 5th percentile. That's your worst, or the 5th percentile of worst final equity. And the FE95 is right up there in the best outcomes of all of those trades. But the FE50 is your kind of your average outcome. And that's why it's highlighted here. And the way that the numbers work out is you can think of it as anytime you see a number greater than 1, that was a positive outcome. And if it's less than 1, that was a reduction in your initial equity. So the final equity would be less than the initial equity. And then the same is done for the drawdown. So drawdown is figured for each of those runs. And so you end up with a percentage drawdown. So obviously a lower percent drawdown is better than a higher percent drawdown. But if you look at these results, you can see that moving average 20, the test was greater than 50. So if the moving average, the 20 period is below the 50 period moving average in these trades, you ended up with a much better final equity and a much lower maximum drawdown. And if you took the trades where the 20 period was above the 50, you ended up with a lower final equity and a higher drawdown. In this case, this is one specific stock I'm looking at, Microsoft, in an up year. Okay, so that may have been surprising. So then why not take a look at Microsoft in the recent bear market? So from the first, pretty much from the first of the year through to Friday, let's pick out the boxes here. The boxes indicate where the 20 period moving average is below the 50. And take a look at those bars. Take a look at the bars that are outside the boxes where the 20 period is above the 50. And then decide for yourself which set of trades would you prefer to have if you were to put these into a black bag and pull them out randomly. From which bag would you prefer to pick your bars? And so here's the answer. Running this in the simulation, taking 1,000 sequences of, actually it's 1,000 sequences of 50 bars is the way that this is run. And in this bear market, if you had chosen from the bag containing these the bars where the 20 is below the 50, you would have actually at the 50th percentile have been actually positive in those trades. Now that's only just occurred because when I did this presentation back in June, that was still, the FE50 number was still a negative result. But just in the last month, that has for the year turned positive. But if you'd have been only trading when the 20 is above the 50, you'd have been in every single run, you would be down, and your maximum drawdown would be pretty high too. So, yeah, so now we've compared one stock in a pretty much a reasonably straight up here with a few pullbacks, minor pullbacks, compared to that same stock in a pretty much a bear market. So we've got two great cases to compare, and in both cases, you would prefer to have been in the stock on the days when the 20 period moving average was below the 50. So that's just one stock. So then the idea was, and I chose these stocks doing this test randomly, and just picked them before I even did the testing. I just picked them out mainly because everybody knows these stocks. So I've chosen Microsoft, I've chosen Apple, and then I chose an index, SPY. Okay, so here's Apple. So we run the same kind of analysis on Apple. I've highlighted the times when the 20 period is below the 50 period. And then, we can sort of visually look at this and we can kind of see that these bars are actually better bars to be trading. Even though there are some down bars in the boxes, in the bars that are outside the box, there's way more down bars. So running that through the analysis ends up with a result with, again, the bars where the 20 is below the 50 were better, with a lower drawdown as well. And then let's take a look at the Apple during this recent bear market in 2022. Again, this is through to Friday, just gone. So it's all current data. And in every case here, the final equity number was actually less than the equity that the account was started with. But the times when the 20 was below the 50, those bars were better bars to be trading. If you buy at the close of that bar and sell at the close of the following bar. So you're buying at the close of the bar where the 20 is below the 50 and selling at the following bar, regardless of where the moving averages are, is the idea here. Okay, so not as much of a difference here. You've got a 0.98. So that is a loss in when you string the numbers together, and a 0.92, and then the drawdowns of 15% and 16%. So pretty close. But the middle line is also interesting. The middle line, I should have mentioned before, is if you take all of the bars, so 143 bars so far this year, and if you take all of those bars, that's the number, 0.96 and a 15.5%. So, and if we go back, you maybe want to check out the middle line from the Apple trade January to December. The middle line was 1.06 if you traded every single bar. But if you just cherry pick the bars where 20 was below the 50, then you had a 1.15. So those were definitely better bars to be trading. Okay. So we took a look at that. Then I thought that, so rather than looking at just the 20 period and the 50 period, they're very also cherry-picked numbers. It's a good idea to run across a variety of moving averages. So then my idea was just take a series of moving averages from 3 period over here, all the way up to the 200 period, going in some kind of sensible movement. So you go from the 3 period, the 5 period, 7 period, 10 period, 15, etc. Once you get up to 21, that's your 1 month essentially. Then it jumps to 30, then 50, then 100, 150, and 200. The final column is the column we've just looked at, the 20 and versus the 50. So, but this time it's not looking for one of the moving averages to be above another. It's looking for the close price to be above or below that moving average. So we're looking here, Microsoft January to December with 11 of these moving average factors. The all bars number gives you a 1.09. in your final equity with a 6.1% maximum drawdown, this is the number that you can compare everything else against, because that's taken everything into account. And now, if you look at the aboves and the belows, most of the tags that are higher, that give you a higher final equity, are when the close price was below a certain moving average. That's January to December. The only slight difference here is you've got the 10-period moving average, where it was better to be in the bars where the close was above the 10-period moving average. But you're down at this level, you're getting down into very similar numbers if at the final equity level. So 1.1, 1.1, 1.09, 1.09, etc. All of these are very similar and very close. And every time you run the simulation, they're going to vary a little bit and put those aboves and belows in slightly different places. But the ones that really stand out are these ones up here with these higher final equities. Now, you do have to, when you're doing this, you do have to be careful about the number of bars that you're using, essentially that you've put into this black bag that you're pulling from. Because sometimes, for instance, I've got the count here in column J, and in the highest performing run, this is the close below the 100-period moving average. There were only 3 bars in 2021 in Microsoft where the close was below the 100-period moving average. 2 of those were positive outcomes, and 1 was a negative outcome. The average percent return was 1.48%. So obviously, when you put those into a black bag, and you're just pulling out from those, you're getting some very good trades. So it really makes this result seem a lot higher because you've got essentially 2/3 of the trades were winning trades and a high average percent. So you have to bear that in mind. And then if you look down at the middle row, you'll find how many bars were considered in the whole of the run. So 251, that's a year's worth of trade. Normally it's 252, but last year there were 251 trading days, funny enough. Okay, so that's interesting. Let's go and look at, and the chart down here is just a reminder of what Microsoft was doing in 21. You've seen that chart earlier. So let's move on to January to July. So this is again the chart. This is the down period. Now, the trades that turned out to be better in terms of final equity were pretty much all where close price was below the moving average, even in a down market, which could be, is it surprising? It could be. To me, it was surprising to see this. So, but it's always good to run the numbers and check it out for yourself, obviously. All right, so that is Microsoft. Let's take a look at Apple quickly. Sorry, SPY. Oh, we're going on to SPY now. So this is the index. Well, the S&P 500 proxy, essentially. So a proxy for the SPX. And the result in SPY for 21. Again, look at all of the rows that are above this blue line here. Okay, and I have a bigger chart of that just to let you see that a bit more clearly. You can see that pretty much every bar where price was below a moving average was better to trade when price was above during the up market of 21. And then SPY in the down period, so far in 2022. This is a result. Again, a lot of these are better bars where price was below the moving averages. There's 2 here that sort of stand out because they're 2 aboves in a sea of belows, and that's the 10 and the 7. And then if you go across to look at the actual numbers of final equity, you see they're very close. You're going 0.95, 0.96, 0.97, 0.98. So everything is pretty close there. But again, interesting that that seems to pick out those bars as being better bars to be trading. In this case as well, so the average maximum drawdown for all of the bars was 12.6%. As you go up this list, the maximum drawdowns do seem to get lower, meaning that they're less volatile bars to be trading. And as you come down this list, the numbers get higher. And then so then the idea was all I did there was I looked at essentially 2021, a full year, and then 2022, partial year. So then I thought, let's just go and run this on 10 years of Microsoft and see what the numbers are for a full 10 years. Here you can see the chart of Microsoft. All right, it's pretty much a parabolic chart up until the beginning of this year. But again, the bars that were better, that gave better final equities, were the bars where close price was below the moving averages. Interestingly, when you start to run it on more data, like the 10 years of data here, you'll see that the final maximum drawdowns end up being higher than the cases where price is above the moving averages. And that's what I would normally expect to see, because when in my mind, I'm thinking when price is below a moving average, then it should be more volatile, because that's an indication of lack of conviction and trading ranges and that kind of thing. So you think there'd be less volatility when price is above, and that is borne out in the data here for 10 years of data, but not when you're looking at just 2021 and 2022, interestingly. So then let's take a look at SPY again. SPY, the bars where price is below any of these moving averages were better than when price was above. And but again, you've got this issue with drawdown, so higher volatility on those bars than the bars where price is above the moving average. And then finally, my last slide is looking at Apple. And Apple seems to be a little bit of an anomaly when you look at 10 years of data, because it's not quite so clear cut, I think, in Apple. You take the row in the middle, which is 2,516 bars. That's considering every single bar in the period, and then you see that's not quite in the middle. So a lot of these numbers here, 1.04, 1.04, 1.04, they're all pretty much identical. So when you run this simulation, this middle row could appear slightly further up the list or slightly further down. It just depends on the particular run, because you are choosing random picks from that black bag of bars. Okay, but here in Apple, the best outcomes were where close price was below the 3 period and below the 5 period. But then the next best outcome was when the close price was above the 15 and then above the 21. So it's not quite as clear cut as in Microsoft and SPY. But nevertheless, I think all of that is interesting when you consider that when you hear about trading, a lot of people have rules in their trading systems that they won't even consider a trade when price is below a certain moving average. You hear that all the time. You also hear you want to see on a higher time frame, maybe on a monthly time frame, you want the monthly moving averages to be going up. You want the weekly moving averages to be going up, and perhaps then on the daily moving averages you don't care as much. But again, you can test these things, and you might be surprised at what you find. But it seems to me from this initial looking at this information that really moving average doesn't really have it seems to have a bearing on the outcomes, but in the opposite way to the way that you would expect. So that's what the data shows for these stocks and those time periods. And now, before I go and show how you can test any indicator. So you can run this exact same test on any indicator. I'll just see if there's any questions on what I've talked about so far. First of all, was that understandable in about the way that I did the testing? I can clear anything up if it's not clear. Thanks, Pete. Seems like Pete is the only one awake at the moment. I'm just kidding. Thanks, Donald. Yep. Okay, so let's move on to this technique. You can. I've lost the chat now. 1 second. Let me just get that back. Okay, here we go. Yeah, so this technique is something you can run in EdgeRater very easily on any indicator. And last week, in the final part of the Getting Started with EdgeRater 3-part series, I talked about how to do trade simulations in EdgeRater using a batch run process. If you missed that 3-part series, you can find the replay. Let me just, the replay will be on YouTube. So let's just bring that up over here so everyone knows where to find it. So if we bring up YouTube, EdgeRater. Okay. So if you look on YouTube, EdgeRater, if you are not currently a subscriber to the channel, please do subscribe and also set notifications, turn them on, make sure you can receive whenever there's a new video posted. But the 3-part series is here in the upload section. Also, I've put it into its own playlist, Getting Started with EdgeRater, and part 3 is all about backtesting. Okay, so it actually turns out to be quite straightforward to run these tests. So the first thing you can do is you take your trade simulation batch run template, and there's input configuration files. Last week I talked about how you would prepare your own configuration file, but there's a bunch that are built into the system already. The sim daily returns basically runs a test which gives you the returns of close to close trades, open to close trades, and close to open trades. Essentially, that's what it does. So if you select your simulation batch run, you choose a symbol list. I'll use the CBOE weeklies list here, and then you choose a folder to output the results into. And I'll just put in, I'll call this sim CBOE daily. That's it. And I'm just going to run it over 2 years from 21 to 22. And I'll just hit run. So it's going through the entire list, 604 stocks, and calculating what the close price to the next close is, basically doing a trade simulation on those trades. It's doing 3 separate trade simulations. The close to close simulation, which is just completed. You can tell at the lower left, you see the processing. Now it's running close to opens. So it's stringing all those together, taking the close price of one bar, holding long to the open price of the next bar. So that's your close to opens. And then now it's actually moved on now, and it's doing the open to close side, which is obviously taking a long trade at the open of one day and closing it at the close of that same day. So it doesn't take that long to run through these 600 stocks over 2 years and come up with a final report. So let's take the chart off for now. This report is just a summary report, so it's not really, it's interesting, but it really is just a summary of the simulations that have been run. There are actual reports that are the simulations themselves. So if you click on open linked document here, you'll open up the entire trade list. So let's open that document, open linked document. I selected. Okay, so here we are. So this is the entire trade list. You can imagine there's quite a lot of trades in here. We go down through the list. We've got 2 years, and we're going up to basically 236, so 250,000 trades in this list, taking all those 600 stocks over 2 years. And you'll also see a trade summary here. So it'll tell you how many of those were winning trades, how many were losing trades. So that's basically your close to close trades. Go back to the summary report and you can see, I don't know if that's big enough for you to see. Let me zoom in a bit. There we go. Yeah, so going back to the summary, you'll see how many trades were there. Then the average percent, number of bars held, because close to close is held over 2 bars. We'll say 2, but obviously the open to close is all 1 bar of trading. So that's 1 bar. But interestingly, you'll see that the close to close price has an average of 0.02% gain, whereas the close to open price has an average of 0.05% gain, and the open to close as a negative average. So that, to me, that indicates that you actually, most of the money on the long side is made here, close to open. So that's one interesting thing to take away from that. Now, if we open up the file system and we look under Documents, EdgeRater, and look under Reports, and then the folder that I chose to put these into is the Sim CBOE daily folder. So these are just Excel files that have been produced, and that's where they are. So you've got the summary, which is what I'm looking at here, and then you've got each of the individual trade simulations. So then, and I probably ran this on way too many stocks to run the multi-factor analysis, but let's give it a try. So what this might take a while. Yes, this might take a while. So yeah, so earlier I did run I'm not sure how long it would take, but what I'm going to do to be safe here is I have the same exact same thing that I ran, but using only 3 stocks: Microsoft, Apple, and SPY. So I might use those for my multi-factor testing, just because I'm kind of a little concerned it will take a long time to run it on 600 stocks, but it might not. We don't know. So what you then it can do is you can go to your multi-factor trade analysis template. You'll find all of these templates under trade simulation. And you can choose the files that you want to put the factors into. So this will make sense when I go through it. So basically I can choose any of those trade simulation files. So I will choose under the Sim Daily, Microsoft, Apple, and SPY, I will choose the close to close simulation file. That's the file that contains the close to close prices for those 3 stocks. And then I can choose what factors I want to actually test. By default, it's going to just test a kind of a seasonal factor, i.e., day, Monday, Tuesday, Wednesday, Thursday, Friday, what week of the year it is, what month of the year it is, what year, etc. So you can run that, and that's actually very useful to run that just on, say, the index SPY over a 20-year period, and find out what days of the week tend to perform best, or what weeks of the year tend to perform best, or which trading day of the month is better. And the one that people get confused about is the TDEOM, which is trading days to end of month. But I'm not going to look at those seasonal factors here. What I'm going to do is select a file that contains tags, which are, there are some built-in tags here. The MA relative tag is the one that I'll choose. Okay, MA relative is right here. So this has got all of those tags built in. And if I run this now, it's going to generate for me the results that you previously saw. Let me do that. Okay, so this has given the results. It's not given it in an order of highest final equity to lowest, but you can just click on the final equity column a couple of times, and you'll end up with this report sorted in that way. And then you can see that I can look at the all trades here. So anything above there was better trades, but this is not now factored by stock. This has put all of those stocks together. So there is a little technique that you can use here where you can separate out and get the results for the individual stocks. And so all you have to do is, first of all, let me show you the tag files, because this is how you will be able to do your own analysis using any indicator you like. You'll find them under EdgeRater configuration tag files, and then system contains the tags that are delivered with the system. So tag layout MA relative, let's take a look at that in Excel. All it is a bunch of scans, all right? And there are scans in the system called C above MA, and then a parameter of the moving average. And then you give that a tag name, and you give it a format. These are not the actual values that are used. This is just the format that's going to be used. But what it will do, it will use this range converter worksheet to convert where a value equals 0, it will say that's below, and when value equals 1, it will say that's above. So that's the way they work. But what you can do is copy that to, and you'll notice in here there's lots of different tag files where you can choose different kinds of indicators to test. But what you can do is copy that MA relative upper level and add a couple of things. So I've added in here symbol, the actual symbol. So now I can separate out those results by symbol. And also I've put in here the year, so you can separate it by year as well. Okay, so in here, if I just select that tag file, I'll come down to tag files, choose my one. And now it's added this symbol and year in here. Now, I don't want to run that as is, because it's just going to then break down all of the bars by essentially in that symbol and all of the bars in a particular year. What I want to do is, watch this, I'll just put a 1 in each of these areas and in these areas too. And my multi-factor analysis is now, I'll just run this quickly, is now going to give me the symbol in conjunction with the indicator. And you'll see a couple of different things occur in here. It takes slightly longer to run this because it's doing a lot more calculations. But now this is the final result of running all that. So you can see it's broken down by all trades in the system, then by, you've got the symbols, and you've got the years. I like to sort it first by the final equity, and then you can do a nice bit of filtering. So you can filter it, say, by Microsoft, and you can also filter it by year. So we can say 21, Microsoft 21, and this will match exactly with the report that I showed you earlier. And when I say exactly, it won't be exactly, because what's happening with this Monte Carlo run is it's actually doing a randomized selection of those bars and stringing them together in sequences of 50. So it'll be slightly different each run, but not massively different. Okay, so that's how you can do that. Then you can easily see, well, what was that like for SPY for 21? That's SPY. What was it like for SPY for 22? Well, that's SPY for 22, and so on and so forth. So that's where tagging can be useful. So you can see if you have a favorite indicator, if it has any effect essentially on the price between one bar and the next bar. So let's take another example. What other kinds of things could you test? You can put together any indicator and run it in a test like this. Let's take a look at the built-in ones though, because they exist already. So let's choose tag layout file, system, Connors RSI. Let's try that. So this is just one tag in this file. It's called Connors CRSI. So it's not separated by, I haven't added in symbol and year, but it's just running CRSI over all of those trades. Let's hit run on there. Okay, and then if we look at the factors here, we can see we have our all trades down here. So that's all 1,185 bars in that trade list, giving you a 1.02 final equity and a 9.4% drawdown. But then if you used Connors RSI, if you chose to only trade when the Connors RSI was between 10 and 20, you ended up with 1.16 final equity out of 111 bars, 55% positive, 45% negative, with an average return of 0.29%. Now, some of these were negative. Okay, final equity being less than 1 indicates a negative final result, and also had higher drawdowns. So these are cases where, it's where the Connors RSI value is between 0 and 10, where 60, 70, 0 to 10, 70 to 80, and 40 to 50. These were your bad cases to trade. And bearing in mind, I'm looking at the 1 bar trade. The idea is, does this indicator have any bearing on the outcome of a 1 bar trade? And you can kind of justify the idea there, because if you're holding a trade for longer, than 1 bar, say you're holding a trade for a whole month, 22 bars, then it's the same as buying it, as I said before, buying it on the close of 1 bar, selling it on the close of the next bar, and then buying it again. It's exactly the same idea. So do those indicators have any significance to certain bars? So that's a way you can do it. Let's see what else we had in there. There's really fun things to play around with, by the way. If you have favorite indicators, or even if you have other trading systems. So you might not just be looking at the trade from 1 bar to the next, but you might be looking at a trading system that holds for X number of bars, depending on your entry script and your exit script. Those bars can vary. You can run a multi-factor trade analysis, and it will then say, well, the trades that were more successful, were any of those indicators, what were the starting values at the start of the trade of the indicators? Did indicators help in any way in the outcome of those trades? So the multi-factor trade analysis is a super powerful thing to run. So let's see what else we could run here out of the default. So this, I think, one really good thing to do here is to find the seasonality in SPY. Okay, as I mentioned it before, let's go ahead and do that. So what I've done before is I've got a list here called Microsoft, Apple, and SPY. I'm just going to choose SPY here, and this list goes back only 10 years, but let's just run it through the whole, however much data we have for SPY, and let's see, let's grab all that data. Okay, so for SPY, we've got from 1993 to 2022. All right, so what I'll do is I'll come to my trade simulation batch run. I'll use the sim daily returns. I'm only going to choose SPY from this list, and I'll say this is SPY all data, SPY daily all data, and I will not override the dates here. So it's going to use the entire amount of data that's in my data snapshot. I'll hit run. So it's gone through all of the bars there. 7,428 bars have been so far traded in SPY since inception. The close-to-close bars had an average of 0.04%. The close to open bars had an average of 0.04%. The open to close bars had an average of 0%. So holding overnight is the where you get paid, as Phil said, Phil Dean, get paid to hold overnight. Okay, so having taken that, we can then go to the let's see, the multi-factor trade analysis. I will choose the file that I just created. So that will be the SPY daily all data and the close to close file. And then I'll say, I'm just going to use this default seasonality. This is what is in here by default, tag layout seasonal. And so I'll just hit run here and see what happens. It'll take a little while because it's going through 7,000 odd bars, and it's going through 1, 2, 3, 7 different factors for each of those bars. And we end up with a final report here. And now what I can do is organize this by click on here to find the FE50, the highest FE50 numbers. And so you can then say, what was the best day to trade overall over the entire SPY? What was the best close to close day to trade? So you can remove the stars here and just see that. So there it is. So Monday, trading SPY close to close, starting on Monday, Tuesday, the next. Then it's this is the all trades level here. Then Friday, Wednesday, and Thursday. So the best trade over the entire set of data for SPY is a Monday trade, followed by a Tuesday trade, and then you could trade any day, and that would be better. You know, any day at random would be better than trading on the Friday, the Wednesday, or the Thursday. And here are the numbers. They're pretty close, but I mean, Monday is quite a distinctive winner here at 4% at 1.04, and we had 53% positive, 47% negative. So on the Tuesday trade, you had a higher number of positive trades, but your average percent return on the Tuesday trades was 0.05%, whereas it was 0.09 on the Monday. Your drawdowns were 6.2 on the Monday trade, 6.4, 6.6. So actually Monday trades were better in both the final equity and the maximum drawdown. So trading SPY on a Monday was good. But what you could also do is break this down by year. So we already have year in here. So we could say, let's find out, let's just choose a year, say 2000, for instance. Okay, you've only got one entry here. So this is all of the bars, 252 bars for that year. So that's not quite so interesting. What you might like to find out is year and day. Okay, so, you know, was it the same? Was the Monday the best stage trade in every one of those years, or just on the overall period? And to do that, you may have guessed what you would do is come back into the report here, and you would just make a combo here that includes the year and the day. So I could just add a 1 in here for year. So now it's going to create a combo of year and day. So let's go ahead and run that. This might take a little while. If anyone has any questions, I can look at questions there. So has anyone been, let's say, interested, now sort of enticed to go and try this out for themselves? Because really the purpose of these webinars is to, you know, it's not really to show the results I found, but to give you ideas to go and test yourself. If you find something, I think with this program, you can find things that no one else is looking at, and that will give you an advantage. So now we've run this with the day and week. So I can then choose, first of all, I'll turn off the star over, well, first of all, I'll sort this in the right direction. Then I'll turn off the star over here. So we're just looking at things that have a day and they have a year. And now I can choose the different years. So I can choose, let's say, so far in 22. How about that? So far in 22, Monday was a better day to trade. Then Tuesday, then Thursday, Wednesday, and Friday. Let's look at 21. 21. Okay, that's now the opposite. In 21, Thursday was better, quite significantly. We know 21 was a big up year. And Monday was actually the worst of the days to trade in 21. So now that's interesting. Let's take that down to 2020. And now we're back to Monday being the best, quite significantly the best. And 2019, Thursday, Wednesday, Monday. So you can go through this and find out all of that information. Now, the EdgeRater reports do not have they don't have the built-in ability that Excel has of doing pivot tables. But all of the reports that are produced by EdgeRater, whenever you run a template on your file system, it will actually put that file, and it's an Excel file. So all you have to do is open up EdgeRater, go into reports. You can sort it by date, and then look at the latest one that's been produced. And these are now Excel, these are true Excel documents. And so using Excel, you can now do something. If you're familiar with Excel and the powerful idea of pivot tables, you can run a pivot table analysis on this, which will yield some really nice graphical results of those, the breakdowns of years and percentages and all that kind of thing, FE numbers. Okay, so I do have a question here. Yeah, so FE50, let's bring that back to over here. And the FE50 number, so this is your final equity at the 50th percentile of 1.04, means there is a total gain of 4% over the full time period and not a compounded return of 4%. That is, I'm just thinking about the way this is calculated. So maybe the best answer for this is to look at, this will be a good way to show that. If we come just into Monte Carlo simulation, and I choose a simulation file, and I'll choose SPY. Let's choose SPY all data close to close. Okay, and then I could choose here my settings, simulations per run, number of runs, and I'll just say run. Okay. So what's happened? The way this has worked out is that you've got original trades over here on the left-hand side. And you can see that this goes down because we're looking at all of the data, 7,436, that's the number of bars. Each one of these represents the gain for that particular close-to-close bar. And then the Monte Carlo simulation is randomly taking, uniform random, it's taking a random pick from that bucket of 7,000 trades, and it's saying that's the chosen trade. So the first line here, the chosen trade, was number 521, and that was a 0.744% gain. And then you've got your initial equity, the amount exposed to the trade, the total gain or loss in the trade, and so on. So what's happening as you go on day by day, it's picking out a new random trade, and it's applying that to your, not the initial equity, it's the amount that's built up. Okay, so as you get 4%, say you've got a 10% gain on the first trade, then you'll end up with, say, 11,000. You'll go from $10,000 to $11,000. The next trade, you're using that whole $11,000 to expose to this particular simulation. But it does this 1,000 times. It's got 50 trades here, right? 50 here, but it's running that 1,000 times. Every time I press F9 in here, I'm going to actually generate a different sequence. It's going to pull out different random trades and put them in a different sequence. And you can see this relative equity line sometimes will be positive and sometimes will be negative. And it's just going to vary because you're picking out random trades. But it's building up a picture every time you do this and storing that result in a list, essentially. And what you end up with is something like this. So so this is taking all of the 1,000 simulations, and it sorted them by their FE number, final equity number, and then plotted that on a chart. And that's how you end up with at the 50th percentile level. So 0.5 gives you that 1.0, in this case, 1.02 level. And then it does the same for drawdown as well. yeah, so that's the way that works. I think also in here, it does, yeah, it has copied over the original trade list in this Monte Carlo as well. So if you open up this file up in Excel, like I did with the summary report, you will see the original trade list as well. So that's the Monte Carlo. If you're running Monte Carlo analysis as a one-off run, what the multi-factor trade analysis does is it just runs this many times for all of the different factors that it's looking at, and then produces a final summary of everything together. But what it's really doing behind the scenes is running this many times. So if you just come back into the Monte Carlo simulation run and just run that on your trade list, you'll get a good idea of how it's all working. And yeah, so this is, I mean, we're getting into the more interesting parts of EdgeRater and to do with the testing. So the back testing, it's super powerful, these features, and I'm wouldn't be surprised if you have to watch this a few times, Pete, on YouTube before it clicks. But I think if you run this, the simplest thing to do to get a feel for it is the simple process of just coming into your trade simulation, choosing your trade simulation batch run, create yourself a symbol list that contains just one stock or a very small number of stocks, say SPY. Use the default settings for this template. You don't even have to change the output folder. Just say, the output folder by default is my trade simulation 1. Don't change the override dates. Just leave everything as it is and just press run. It will produce a report for you. And if you look then on your hard drive, you'll see my trade simulation 1 is the folder it put that into. And these are the reports that were generated. And this is the summary outcome. And once you've done that, then go to your multi-factor trade analysis, use the defaults again, but this time you do have to choose the simulation report. You'll find that in whatever the output folder was. And you can use the close to close. Click on open there. And then choose your tag combinations or tag file. So the seasonal file is on by default, but obviously there are other tags that you might want to test, or you might have your own types of tagging to use. And a technical analysis tag can be any technical indicator. All right, so if I'm looking at, let's come over to, we're on SPY. I'm looking at candles. Let's just come out here. Yeah, so I chose to look at these moving averages, but in your chart scripts, you have all of these indicators already built in. You've got your Bollinger Band %B indicator. So you could create a tag file, for instance, that has %B ranges, greater than 1, less than 0, anything in between, and then run your tagging using that tag file. And then it will break down the gains into where the indicator was, or the range of that indicator on each of those bars. So it's very, it will do a lot of processing for you. And it really saves you from having to run lots of simulations manually. So for instance, you may have had the idea that you want to trade a particular trading strategy, and you've got your system worked out, and then you may want to add in more indicators, because when you're looking at the chart, you can see that it seems like you get better results when %B is below 0, or when it's above 1. And so you then might have gone back in and added it into your trading system as a qualifier to take trades, just to see what the results were. But there's no need to do that. You just can run, after you've done your core simulation with your entries and your exits, you take that trade list and you can run it through some tagging to see if any indicators had an effect on the outcome of your trades. So, so yeah, it's good stuff. and I hope everyone gets a chance to play around with it. The original part of this, the original question of this presentation is what's the best moving average, and really the conclusion that I've come to with my testing here is that there is no best moving average, and oftentimes it's actually better to trade against what is commonly thought is the best situation in terms of where close price is in relation to moving averages. Another test that I would highly recommend running is, rather than just moving average, would be a test using the slope of particular moving averages to see if the slope has any bearing on the outcome of certain bars. Anyway, it's all good stuff. I hope you learned a lot. Pete, okay, so I think, so Pete's asking if there's going to be a meetup in North America or Western Europe. So I don't think there's going to, we had a meeting with the Orange County workshop group in June, and I believe Greg is trying to organize something else, another meeting in maybe October or November. So I have to sort of, we don't know anything for sure yet, but we can keep you posted on that. And that's actually a weekend of training with the likes of Jeff Scott and myself and maybe Dev and several others. But yeah, I don't, if there's any other meetups that people just want to do, as in meet up and have a beer and talk about trading, then I guess that would be possible too. It's always fun to talk trading. But we have Zoom these days as well, so we don't actually have to be physically in the same location. Anyway, stay tuned for the next webinar, information about what's coming up. So I hope to do something next Saturday as well. Haven't decided yet on the content of that, but I'm sure it's going to be interesting. I'm sure it's going to be interesting. So anyway, stay tuned for that. The goal is really to get everybody to be able to use the program properly and work out their own trading systems and ideas. And hopefully everyone can then have their own trading system that suits themselves. So that's the idea. We're working towards that. Have a great weekend, everybody, and we'll see you next time.